Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor, and what people are calling very interesting times.
Well, Jim, good to be back with you. Thank you.
Since we talked about a month ago, many of the leading stock market indices have fallen about 20% from their all-time highs. What are your thoughts on what's going on?
Well, yeah, they have had a fall, and it's been incredibly fast. I think you can see quoted here and there how fast it was, but basically it seemed like it was the fastest drop of that magnitude that maybe we've ever had. I know Monday of this week we had the biggest one-day point drop in the Dow Jones, down about 2,100 points. We're at 15-month lows or thereabouts on the Dow Jones Industrial Average. The transports, the Dow Jones transports, they're down about 30% at a 3.5-year low. And you're right, some of the leading indices like the Toronto stock market, the S&P 500, the NASDAQ 100 index, all down about 20%. The TSE, interesting, of course, getting extra downside pressure from the energy markets, and the banks have been getting hit pretty hard as well. But, you put this in perspective. I mean, we're going into the early part of February, the major indices were trading at all-time highs. And as I was writing on my blog on our website, that Polar Futures Group, it was like the stock market was ignoring the warnings that were coming from the bond market, from the gold market, the copper market, the crude oil market, from the U.S. dollar. It was like the stock market was in a whirl of its own, in a way, that people just kept buying stocks because, it's sort of the old, what was that thing from Mad Magazine, What Me Worry, I saw the virus kind of as a catalyst that hit a market that was waiting for an accident waiting to happen, something that was sort of priced for perfection. My thought on it has been that, over time, when people couldn't get any interest on putting some money in a bank or, GICs and that, they would go out and take on more risk. They got rewarded for doing that, so they did more of it and they kept doing it. And it was like, gee, this is great. So there was leverage building everywhere. And when I say people, I mean there was folks and there was institutional accounts and, just everybody became more aggressive. And it's almost inevitable, like late in the cycle, that suddenly risk happens fast. And I think it's the speed of this decline that's really worried people. Now, there's obviously a lot going on here. The virus has, I think, it sort of hit a different kind of a nerve than if it was just a financial crisis. This is the thought of, gee whiz, that people are dying. This is nobody can control it. The central banks, the governments aren't able to. That's the fear is happening there. So it's a visceral, biological fear. But given all that, I mean, we are now on the major stock indices, I should say, back to about where we were a year ago. So for the past 14 months, actually, the stock market has rallied this whole distance and given it all back then in 3 weeks. That's one of the ways of looking at it. From where I sit here trying to trade this, and I have been active in the markets, I've seen volatility explode. And, what is volatility? Volatility to me is, let's say that the volatility has exploded as liquidity has kind of disappeared out of the market. So what that means is if I'm looking at my depth of market page here where I want to see what the offers are stacked up above the market, what the bids are, stacked below the market, the depth of the market has just really gotten thinner, whatever market you're looking at. The spreads between the bid and the offer in some of the markets at different periods of time here has just gone incredibly wide. So, if you were to instantly go in, hit the bid, hit the offer, you would lose a lot of money. And then I think another way of seeing volatility exploding is the speed with which markets have moved over short periods of time. I mean, just as we're talking here, going into the close on Wednesday, the stock market, which had been, let's just say the major stock indices, I keep saying the wrong thing, which were up strong yesterday after being down hard on Monday, are now down hard again, and are looking like we're going to make new lows for this move down. For the Dow to be up or down 1,000 points or more seems to be almost routine here the past couple of weeks. Now, I should say this, I noticed this, that 78% of the S&P 500 stocks have got a dividend yield that is greater than the yield you can get on the 10-year Treasury bond. Now, at some point, some folks may see that the market is a bit of a bargain. But right now, we're really trading nothing but psychology. Call it fear and greed, and there is no greed. Sometimes you can see short-term as the market rallies, I think people are going, oh my God, I got to get in. That was the bottom. But really, the fear is what seems to be running this market more than anything else right now. CNN has a fear-greed barometer that they have that goes from 0 to 100. Well, we're down just above 0, which is the same kind of levels that we got at when we were making the lows at Christmas time in 2018, when the major indices were also at that time off about 20%. So this virus, I think it's a different kind of panic in the market. And I think there's a good likelihood that the virus news is going to get worse in the United States. It seems, as we follow along different countries in the world where China, kind of the virus ramped up, and it appears maybe it's contained, although a lot of folks will be suspicious that the news that comes out of China is managed. But then you look at South Korea, same kind of thing, had a quick ramp up, and now it seems like they've really got that contained. Whereas maybe, Italy, it is still in the ramp up phase, and America maybe hasn't even got to the ramp up phase yet. So given that the virus is a real driver of the panic that's affecting the financial markets here, you'd think that there's a good chance that if in fact the ramp up in the United States has yet to really hit, then we could have more of a hit on the stock market. Another aspect of the stock market is what I'd call the ripple effect, and that is, if you think of the old, drop a pebble in a pond and the ripples go out, at the epicenter of where the pebble hits the water, that's the people that are watching the market extremely close, and they're trading in and out of it all the time. But as you get the ripples go further out, you have people that are not really paying attention to the market every day. They've got a life, they're doing their job, whatever. And then they start hearing around, and then they go check on their accounts and go, gee, I was going to be a long-term holder on this, but, maybe I should be getting out. So I don't think we've seen those folks show up yet, so there may be some more selling pressure. Another issue has been the election. At the conference that I was speaking at in early February, I said I thought the election was Trump's to lose. The market's assuming he's going to win. But if we go into the election, and that's a long time away yet, November of this year, if we go into the election with the economy in a recession, then I think there'd be a good chance that whoever, is running against Trump, the incumbent, could win. And maybe one last thing, Jimmy, the interconnected world that we live in these days, it shows up. We're seeing some of the vulnerabilities, I guess, of that, not only from the contagion of this virus, but, the supply chains that we have and the interconnectivity between the financial markets and so on. So that kind of amplifies things. So, it's great when it's working normally, but when everybody gets into a bit of a fearful frame of mind, then that interconnected world really kind of feeds on itself and maybe accelerates some of the momentum.
While stocks have been falling, bond prices have been rallying, long-term interest rates have fallen sharply, and many central banks have been cutting their short-term interest rates, the Bank of Canada, the Bank of England, and the Fed. Has this been a classic example of why people should hold a balanced portfolio of stocks and bonds?
I'd say absolutely. I don't typically, for my own account, think in terms of a portfolio. I'm a trader, but I know I'm by far in the minority. Most folks that have got some money set aside, their savings and their RSP or whatever, and looking forward to, being in the market for years, instead of having, everything, all your eggs in one basket, you want to have some diversification. And the classic sort of modern portfolio theory idea has been you want to have, X percent in the stock market and X percent in bonds, and then a little bit, dribbled in other things. So certainly the huge rally that we've seen in the the bond market, that is, bond prices go up as interest rates have fallen, has been a great balance for the losses that, paper losses or whatever that people have taken with the stock market going down. So yes, it has been a great idea. I think the bond market, as I was saying earlier, had been flashing a warning in January and February to the stock market, and the stock market ignored it. The bond market, I think, saw a recession likely coming. We'd been in the longest economic expansion in the history of the United States. The bond market probably felt that it was getting long in the tooth. The virus, I think, was starting to show up then, but still the stock market ignored it. So the bond market kind of got a safe haven bid. And then as the bond market rallied, it was just incredible to watch it. I mean, it went, and you think of bonds are usually, gee whiz, that's just about so boring. Even my grandmother, would fall asleep talking about bonds. But the bond market had such an incredible rally here that may have peaked out this week. It looked like, breathless resources on the old Vancouver Stock Exchange. It was just an incredible run-up. And I'm wondering if maybe now the bond market, looking ahead, is discounting the prospect of lots of supply coming out of the market. In other words, what we're seeing now, it looks like the market's taking a view that the central bank really can't do a lot more. So now it's up to the governments to do something. And with interest rates at such incredibly low levels, maybe the government should go out, borrow a hell of a lot of money, and stimulate the economy. So the bond market may be anticipating that. When we talk about interest rates, we also got to talk about different quality in the interest rate market. So while the interest rates or the yield on government paper has been just falling like a stone, over on the other side of the market, the corporate debt of those interest rates are rising, especially, as you can imagine, in the energy sector, where they've issued $100 billion and change worth of bonds, and there's a lot of worries there that people that lent that money aren't going to get their money back, that there will be default. So you got interest rates on the one hand falling with top quality paper, interest rates with shakier credits, interest rates are going up very, very sharply. So, and I guess maybe you could think, with the central banks doing what they're doing, does it help much, or is that just indicating panic? I think a key in terms of fiscal stimulus that is going to be Germany. Germany has maintained a real, what they call a black hole program, where they believe in austerity. You pay as you go and that kind of thing. I think austerity is going to go out the window here. And the governments, for instance, tomorrow the European Central Bank is meeting. The new head, Lagarde, is going to be really leaning on governments to go out and spend money that the central bank can't do much more. Jimmy, we may just be at the bottom of the sine wave in terms of inflation. The expectations have been, I think the consumer survey in the United States last month showed that inflation expectations were at a 30-year low. We may be seeing inflation in our future as a hell of a lot of debt is issued to try to stimulate economies.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Victor Adair. Victor, crude oil prices are down about 50% from their January highs, with a big gap down just this past weekend when Russia and Saudi Arabia couldn't agree on production cutbacks. What are your thoughts on crude and energy shares?
Well, Jimmy, I mean, we had crude, that's WTI, was at $65 in January when the United States and Iran looked like they were going to start to bang heads. Since then, I guess, as you say, we're down about 50%. We actually traded under $30 on the Sunday night, early Monday morning session here. And I think, I mean, we'd been down, I'm going to say it was about $4 or $5 on Friday as the news kind of was coming out that Saudi and Russia weren't agreeing. But I guess over the weekend, folks just really thought that through, and it was like, oh my gosh. And then, what maybe was just like a temper tantrum by the Saudis. They just said, okay, that's the deal. Then we've had this role of being the swing producer. We're just going to flat out produce as much as possible and grab market share, and it's everybody for himself kind of thing. So we had the sharpest two-day decline in WTI since the Gulf War in 1991. It was a real hard break. That's the lowest prices we've seen on WTI since 2016, January 2016. And if we do weaken and drop below those lows, then we're looking at we'd be making new 17-year lows. So prices are really down there on WTI. You look at some of the other the energy stocks. I mean, the big ETF in the United States, the XLE, is at a 16-year low. Exxon share prices 16-year low. Schlumberger, which is one of the leading world oil service companies, their share prices are at a 25-year low. I see CNQ here in Canada about a 15-year low. The TSE Energy Index is down about 50% in 3 weeks, and some of the companies that are sort of high debt companies are down more than that. The concerns here is that they will not be able to refinance debt or service that debt, and will either get taken over or just fold or whatever. And by the way, natural gas is near 20-year lows. So there's, and one other thing, the Western Canada Select, the price that we get for Canadian oil in the low 20s, and I'm sorry, I'm not right up to date on that. So that's one of the reasons that also feeds through the Canadian dollar being down. Where are we at it? I mean, we've got shale, which over the last 10 years has accounted for about 80% of the growth of production in global liquids. Shale, I think the prospect here of shale, the expectations had been that they'd be increasing production by 1 million barrels plus this year. That's very unlikely going to happen. They're probably, at best, may be able to sustain current production. More likely, especially if some of them start to go broke because they can't service their debt or make the payments or whatever, roll it over. So production there may not continue to grow. Saudi's talking about going to 13 million barrels a day. I've seen some folks that I think really know what they're talking about say they don't think there's any way Saudi can get their production above 11 million barrels a day, which would be not much more than I think 500,000 barrels a day over and above what they've been doing lately. And Saudi needs $80 oil to keep their balance, their budget balanced. So we may be in a situation here where Russia and Saudi really banged heads over their inability to be able to agree on production cuts to try to sustain oil prices, and we may see one or both of them sort of throw in the towel on that and back away from it. Whatever. And then I suppose if you want to be hopeful, I mean, maybe China will decide that they will build some of their inventories with really cheap oil down around $30 here. But I don't want to be, Pollyanna about this. I think the other side of it is that if we drop through the lows we made 2 days ago around $27, and we take out that $26 print we had back in January of 2016, then we could take another serious leg down. We are really trading psychology in these markets right now with the fear, and it's not what the supply-demand balance is. I mean, I know I don't even pay attention to the economic reports that we get out every morning because that just doesn't matter. It's this fear and greed, and there is no greed, psychology that's driving all of the markets now, not just the stock market.
On your weekly blog, you've noted a couple of times the U.S. dollar index hit a 2-year high in mid-February, just as the major American stock indices were hitting all-time highs, and then both the U.S. buck and the stock indices began their sharp fall that's been on for the past month. What do you think's been driving the currency markets?
Yeah, the currency markets have been, you go back to Christmas time, thereabouts, the volatility in the foreign exchange market was at an all-time low. Like the market was more than dead in the water. And, be careful what you ask for and all that sort of thing. And that's certainly changed. Going into the very end of the year, the U.S. dollar had weakened. And I remember you and I were talking, and, I'd been a pretty resolute U.S. dollar bull, and I was starting to wobble a little bit. And then things turned around at the beginning of the year, and the U.S. dollar just surged against everything. And let me amplify on that just for a moment. To me, there's two kinds of currency markets. There's what I call the developed markets, and that would be, the euro, the Swiss, the British pound, the Canadian dollar, the Japanese yen, that sort of thing, the Australian dollar. And then there's the emerging markets, whether it's, the Russian ruble, the South African rand, the Korean won, that sort of thing. And they're two different markets. So we'll, in terms of, as a for instance, the Canadian dollar, the Australian dollar are seen as commodity currencies here. The Australian dollar, I think, serves as a bit of a window into not only the Asian market, but in emerging markets in general. The Australian dollar, just here the last day or two, has been at 11-year lows, and it's down over 20% from where the highs it had 2 years ago. So it's really the strength of the U.S. dollar, in other words, has shown up more in those kind of markets than maybe in the main markets. And even at that, the euro has been sort of relentlessly going down as the U.S. dollar went up. One of the things that I thought was very interesting, and I wrote about this on my blog a couple of times with respect to the synchronicity of the U.S. dollar peaking at exactly the same time that the major U.S. and global stock markets peaked. And that was, I remembered that movie Margin Call that came out, I don't know, it seems like maybe it's 10 years ago or so. And there was a character, Jeremy Irons, and he's the big guy, and he says, I'm paid to hear if the music is still playing. And, I don't hear any music. So for people that have seen that movie, they'll know exactly what I'm talking about. I just wondered if at that point there wasn't some big European institution that had been heavily invested in the United States stock market. And remember, for the past several years, the U.S. stock market has way outperformed the rest of the world. The U.S. dollar's been going up. If those folks were invested there without hedging their foreign exchange risk, they'd made a huge double whammy. And if they thought it was time to say sayonara and take their profits and get out, that may have had something to do with the markets turning at that point in time. Now, Since then, as the stock market has gone down, the U.S. dollar has gone down, particularly against the euro, the Swiss, and the Japanese yen, and those last two, the Swiss and the yen, often seen really as safe havens, particularly the yen lately. We've really seen money flow there. But the other currencies, the commodity dollars, as I talked about, and the the emerging market currencies have gone down. So currency markets have been, it's not a monolithic market. The U.S. dollar has been up against some, down against others. And the volatility is back with a vengeance after being, as I say, dead in the water at the end of last year.
We'll have more with Victor Adair right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, gold hit a 7-year high above $1,700 on Monday, but dropped back about $50 since then. You previously told us that falling interest rates have had a big bullish impact on gold, but has gold also benefited from safe haven buying?
Oh, absolutely. I think gold is definitely, the classics. And I have been involved in gold for 50 years, from when I was practically a kid in those days, trafficking in gold bullion before Americans could legally own it. So I've been around that market a long time, and one of the classic selling points, I guess, for gold is that it's nobody else's liability. If you buy a government bond, then you're kind of counting on those fellows to honor the obligation they have to you. But if you got a bar of gold in your hand, unless somebody takes it away from you, it's yours. So yeah, definitely gold has benefited from safe haven buying. We've seen in the last year and more a ramp up in the holdings, the gold ETFs, and the gold on that's the speculator's position, I should say, in the paper futures markets, where people have gone in there and bought more and more and more. But the rising bond prices, the falling interest rates, I think, have been a real key support for the gold market, even if it's just as simple as now there's no opportunity cost, as it were, to owning gold. It used to be, let's say, if interest rates are at 5 or 10%, and you take money and you buy gold with it, and a bar of gold sits there, like a rock on the side of the road, you're not earning anything from it, and it's costing you. You could have just had your money in T-bills or whatever. But if T-bills pay nothing, then, gold suddenly becomes much more attractive. Last week, we saw the gold market have a $125 range from the top to the bottom. When I saw that break, I'm forgetting what day it was, and it broke pretty hard one day. It was down, I think, $50 or more in one day. I thought, okay, I think I've seen this before, and that is a case of sell what you can, not what you need to. In other words, people with margin calls in the stock market might have been blowing out their gold position or having it blown out for them by the margin clerks who were looking for wherever they could get money. We've seen open interest in the futures market fall here, certainly the last 3 weeks and more. That's a bit worrisome, although on the other side, the ownership of gold ETFs has continued to rise. I'm inclined to think that gold's a little vulnerable here. Not the least reason for that is the bond market is actually trading down a little bit here today, even as we've got the Dow Jones at one point here today down over 1,500 points. So maybe the relationship between bonds and stocks is breaking down a little. Maybe the bonds looking ahead to inflation in the future, although you'd think that would be bullish for gold. I don't know. The gold market has had a great run over the past year and a half. And as I was saying earlier, we're trading nothing but psychology right at the moment. You know, the facts and the figures don't really make any difference. And it might be that a 7-year high above $1,700 here in gold is being seen by some folks as an opportunity to take profits. We've certainly seen gold way outperform silver. Silver's sort of look like it's more tied to the copper market than tied to the gold market. So there you have it. I'm a little muddled on gold, I guess. I have a bearish option position in gold right now. I just think it's a little vulnerable, but it's had a great run, that's for sure.
How have you been trading these markets, and what are your expectations going forward?
I've been trading this market thinking, as I said, I haven't really had to pay any attention to the economic news, and I normally watch that very closely because it just doesn't matter in the short term here. That the market is absolutely dominated by emotion right now, and that is not just the stock market; it washes over everything. So I've also been trading much smaller size than I would typically, and I'm never very aggressive, but just in through here. It's just so easy to be wrong. Sometimes it's very hard to get a trade on. I get an idea about something, you know, I think, okay, I think this is going to happen, so how would I structure a trade to do that? Okay, I'm going to do this, and then I go and look at the market and I think, holy mackerel, it's going to cost me an arm and a leg to put that trade on there, or the bid offer is so wide, I'm going, geez. So it's been difficult to trade. In terms of what's coming ahead, you know, I said, the stock market right here, we're right back to where we were a year ago. It's not like we've fallen to zero, you know. I mean, it hasn't been a big move, but I think maybe there's certainly downside risk here. I said earlier, I think the possibility of the virus getting worse, or at least the news about it getting worse in the United States is very real. It seems Americans have been doing a lot less testing on a per capita basis than some of the other places in the world, and as they do more testing, they may find there's more people have got this thing. So that could, you know, put more fear into the market. I said earlier about the ripple out effect that the buy and hold folks, you know, haven't phoned up their broker to say, get me out. You know, that hasn't happened yet, I don't think. And another thing I'd say to folks that are listening, it doesn't have to make any sense. You know, I talk about this with my son Drew, and as I've gotten older, it becomes more and more real to me. The markets that I trade in, I've been trading for 50 years. I mean, I really believe there are folks that are out participating in these markets. I've got no idea who they are. I've got no idea what's motivating them. I don't know what size they're trading. I don't know what their time horizon is. You know, they could be doing stuff, and here would be the tricky thing, I guess. You could buy something because you think blah, blah, blah. The market goes up and you say, well, I guess I was right about that. Not necessarily. You may have gone up for something for a reason entirely have nothing to do with what you thought. But what the risk there is that you think, I guess I've kind of got this figured out now and blah, blah, I'll be able to make money all the time. Maybe, Jimmy, that's a good point to end it. That just understand that it's a fear and driven, mostly fear driven market right now. It doesn't have to make any sense. There's risk to it. I'm trading smaller size. I don't know what's going to happen. And as a good friend of mine said years ago, and I think it's a great quote, you know, if you're going to just maybe sit on the sidelines here, don't worry. There's a rumor going around that the markets are going to open again next week.
Victor, thank you so much for being on the show.
Jim, it's always fun to visit with you. Thank you.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.